Welcome to vTalkInsight, Market Drivers Daily for May 28, 2026. Today, the tension between Middle East geopolitics, an AI-fueled equity boom, and resurgent inflation is pulling asset prices in different directions, just as the Federal Reserve's preferred inflation gauge lands in focus. Geopolitics remains the main macro overhang, with the Strait of Hormuz at the center of the story. After yesterday's lean toward a benign resolution, markets are still effectively betting on a relatively quick reopening, even as military exchanges between the U.S. and Iran continue and the risk of miscalculation stays elevated. That gap between positioning and on-the-ground realities is a key source of fragility for energy prices and risk assets. Recent days have seen fresh U.S. strikes on Iranian targets, drone and missile activity, and new vessel compliance rules near Hormuz, all of which raise perceived risk to shipping and oil supply routes. Equities have reacted with periodic risk-off moves, particularly in Asia and Europe, while oil has swung higher, with Brent trading in the mid to high $90 area at times. Yet some sessions show only modest crude gains as traders fade spikes on headlines about ceasefire extensions and renewed nuclear talks, highlighting how sensitive pricing is to each diplomatic headline. Beneath the day-to-day volatility, the energy system is grinding tighter. Shipping activity through Hormuz remains severely reduced. Asian crude importers are cutting refinery runs and sourcing alternative barrels, and freight costs for liquefied petroleum gas from the U.S. to Asia have jumped to multi-year highs. Physical markets are drawing down inventories toward post-Russia-Ukraine lows. U.S. gasoline stocks sit well below recent averages, and U.S. rig counts and liquefied natural gas exports are constrained by infrastructure bottlenecks rather than geology. Europe looks particularly exposed because electricity demand is outpacing other energy sources, while domestic supply remains limited and strategy unclear. Persistent high oil and power prices have not yet derailed broad equity indices, but rising input costs are starting to pressure European corporate earnings expectations for the second half. At a sector level, European oil and gas equities are benefiting from higher crude, and defense stocks, despite a recent pullback, still enjoys support from rising NATO spending targets and national rearmament plans. The downside scenario is a prolonged or renewed closure of Hormuz that pushes oil sustainably higher, squeezes real incomes for households without financial buffers, and risks nudging developed economies toward a stagflation mix of slower growth and sticky prices. The alternative, still reflected in late-year Brent futures near $80, is a managed reopening that eases the energy risk premium, support a more patient European central bank, and could allow a catch-up in European cyclicals such as tech and consumer names. Key signposts now are actual shipping volumes through Hormuz, inventory data, the tone of U.S. Iran negotiations, and how quickly higher fuel and food costs filter into earnings downgrades or consumer demand. Artificial intelligence is still the dominant growth and earnings engine, but leadership within the theme is becoming narrower and more contested. Today's tape reinforces what we have been seeing all week. Infrastructure and data platforms tied directly to AI workloads are thriving, while parts of traditional software and non-AI sectors struggle to keep up. For multi-asset portfolios, that concentration raises both opportunity and vulnerability if the AI story stumbles. Snowflake is a clear example of how markets are rewarding AI-driven execution. The company raised its revenue guidance with growth in the low to mid-30s, citing surging AI, token consumption, and rapid adoption of new tools such as Snowflake Intelligence and Cortex Code, while also announcing a $6 billion multi-year cloud partnership with Amazon. Its shares have jumped roughly 40%, and the deal is being framed as lowering AI unit costs for customers and deepening the competitive moat in data infrastructure. On the hardware side, Dell's AI infrastructure division has delivered almost $30 billion in quarterly revenue, nearly tripling year-on-year, and the firm now expects around $60 billion of AI server revenue in an upcoming fiscal year. At the same time, about a quarter of new bond issuance is linked to data centers and related assets, with high-yield markets showing strong appetite for AI and infrastructure-backed deals. Constraints in land and power availability are naturally pacing this build-out, which supports pricing power for utilities and grid operators. Enterprise adoption is also reshaping security and workflows. Large corporates are rolling out AI agents across internal systems, driving demand for identity and access management, so each agent can be authenticated and permissioned, an area where vendors like Okta are seeing stronger subscription growth. At the same time, companies are experimenting with AI in sectors as varied as travel bookings, apparel inventory planning, robo-taxis, and even sports officiating, while many are ramping internal training programs despite a persistent res-killing gap across workforces. Despite this fundamental momentum, bubble concerns are not going away. The AI equity rally shows signs of fatigue, with extreme valuations, a narrow group of mega-cap winners, and warnings that a 10 to 20% consolidation in technology and AI names would not be surprising after recent gains. Yet there is still little evidence of a slowdown in AI-related earnings or capital expenditure, and some estimates suggest AI could lift U.S. gross domestic product by up to 10% over the next 8 years, which, if realized, would go a long way toward justifying elevated multiples. Key things to watch now are whether earnings beats and guidance upgrades continue for infrastructure names like Snowflake and Dell, whether AI-driven growth broadens further into industrials and utilities, and how far credit markets and private equity remain willing to fund this build-out. The inflation narrative is shifting decisively away from transitory, and today's personal consumption expenditures data underline that point. Headline PCE is running in the high 3% range year-on-year, with core measures around 3.3% and recent 3- and 6-month trends pointing closer to 4%. Excluding the pandemic spike, this is the firmest underlying inflation backdrop in decades, complicating any case for rapid policy easing. Federal Reserve officials have become more vocal about upside inflation risks, signaling that rate cuts are on hold and that hikes are possible if disinflation does not resume soon. Some policy rules suggest the current funds rate could be 1 to 1.5 percentage points too low for prevailing conditions, even as markets still only price in modest additional tightening through 2026. Global peers, from the European Central Bank's higher inflation forecast to the Bank of Korea's hawkish tilt, are also nudging policy expectations toward a tighter global stance. In rates, 2-year Treasury yields have risen for 5 consecutive weeks. Front-end break-evens have jumped, and the curve is adjusting to a higher-for-longer path rather than imminent cuts. Bond investors report treating yields as range-bound, adding duration when yields back up and trimming when they fall, while acknowledging that any clear signal of renewed hikes could break that pattern. Equities, by contrast, remain near record highs, supported by robust earnings and AI-driven growth, underscoring a disconnect between stock and bond interpretations of the same macro backdrop. So far, the real economy has absorbed higher prices and rates better than many expected, with strong earnings, resilient travel demand, and continued consumer traffic even at discount retailers. But the burden is uneven. Lower-income households are more exposed to higher energy and food costs and the loss of pandemic-era support, while wealth effect from equities benefit the top of the distribution. New home sales are already softening under the weight of higher mortgage rates, and persistent energy costs linked back to geopolitics raise the specter of a more stagflationary mix if growth slows from here. The counter-argument is that inflation, while elevated, is not yet broad-based on the demand side, with wages and shelter components showing limited additional acceleration, and some central banks, including the ECB, still seeing a soft landing rather than outright recession. Elevated yields now offer genuine carry for fixed income for the first time in years, and if growth merely moderates rather than contracts, that income could offset some price volatility. Watch now for upcoming U.S. PCE and wholesale inventory releases, Euro Area Consumer Price Index prints, and any hint the Fed formally removes its easing bias in June or begins to openly discuss renewed hikes. How those signals interact with energy prices and AI-driven growth will be crucial for the next leg in both rates and equities. To wrap up, energy security, AI-driven growth, and a higher-for-longer inflation backdrop are colliding in markets. Hormuz tensions keep an embedded risk premium in oil and freight, even as prices oscillate with each diplomatic headline. AI earnings and capex remain powerful supports for equities and credit, but leadership is narrow and valuations increasingly demanding. At the same time, PCE inflation and central bank rhetoric point toward tighter policy risks than many equity investors are discounting. especially at the front end of the curve. Monitoring shipping flows, AI earnings breadth, and incoming inflation data will be key to navigating this mix over the coming weeks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.